Hey, good afternoon, good morning, good evening, depending on where you are in the world. This is Ryan Payne. This is my monthly mentoring session, so thank everyone for being on who's on right now. And just a little background, if you haven't been on one of these mentoring sessions before, I run a wealth management firm, Payne Capital Management, which I built over the last 11 years. So any questions that are finance related, about your wealth related, or just building a business in general, I'm always happy to answer. So having said that, we got a lot of great questions this month, and I feel like every month we get some pretty fantastic questions, and I'm gonna hop right into the fire here, and we're gonna get right down to questions and take it from there. So shall we? So the first question comes in from Gabor Race. My man Gabor, who I do know personally, wrote in this month, we've been approached by an investor who seems serious about acquiring 50% of our company. This is not a proposal for an investment into the company. It's him proposing to pay my two co-owners and I for 50% equity. What are the important questions to ask in a situation like this, apart from, of course, how much payment we would get? Of course, that's important. I'm thinking along the lines of how much operational control they would want to have, what kind of plans they have for the company once they're a co-owner, how can they contribute to the growing company, what are the key issues we need to help on apart from money if we want this deal to happen. Okay, good questions, right? I mean, it's not just about getting some money for someone to buy into your business, but having control. 50% would say that they've got a lot of control of your company if they were to come in and take that type of ownership. And I'll just put it in perspective of my own company, Gabor, and anyone else out there who's in a situation like this. Like, I have a high growing company right now. I know you're a very successful guy, and you have to look at like how successful is my company and what are the growth projections. And I'm in a position right now with my own business where, you know, the equity is going to be worth a lot more over the next 5 years, 10 years. For me to sell right now would be to sell really cheaply, unless someone came in with what we would call the proverbial sweetheart deal. So, you know, my questions would be, if someone really wanted to take an equity stake, is besides how much, the other part would be control. I think that's a really critical thing. When I look at my business now, and when you reevaluate or you evaluate your business, you want to start thinking about, you know, how much control do you have now and how much would you be able to relinquish? I know in my case, not very much. I like to hold, you know, I like to run things the way I want to run them. So I think that's a really critical question to ask yourself. The other thing you want to ask yourself too is, and this is something you alluded to in your question, is just what's the value add? Let's just say that I was willing to take a partner on in my own business, have them pay in to something that's already growing. They'd have to be able to help me grow my business at a much faster rate. And that would be between maybe his introduction to a new client base or a new customer base. Maybe it's access to some capital that I wouldn't have access to, like private equity money. So what they bring to the table, I think, is really, really going to be critical, because if you've got a good business, it's growing really, really well, which means your equity is going to be worth a lot more in the future. There has to be a value add there that you can clearly see that says they can help you grow your business at a much faster clip than you can do right now on your own. To me, that would be the number one reason that I ever let a partner on board and give equity, especially someone who hasn't been there earning sweat equity the whole way through. I mean, this is your business. You've worked really hard on it, so someone has to come in with some really, really good value add in terms of what the growth prospects are. And I would argue you probably know your business better than anybody, and you'll be able to see whatever they're offering. If it's like, okay, by having this person on board, I'm going to have access to things I'd never have access to. So maybe I have a smaller percentage, but if the growth's going to be that much faster, sometimes having a smaller percentage of a bigger pie is going to be better than a bigger percentage of a smaller pie. So that's the math that you have to run on that. Good questions. If you have any more questions on it, you can always hit me up right here in the comments section, or send me an email as well. I'll put my email up like I normally do for any other questions you guys have offline. Next question comes in from Carrie Bowen. Hope I pronounced that correctly. Carrie writes in questions, Carrie wrote in, I have several anchor accounts for speaking in individual accounts in the financial sector, but my face and message needs to be in front of more financial advisors, groups, corporations. I find more ideal clients in the financial sector than any other: healthcare, tech, e-commerce. What media outlets would be the most beneficial for me to pitch emotional intelligence training in the financial sector Do you believe there is need? Do you believe there is a need as much as I'm seeing right now? What EQ or emotional issues, emotional intelligence issues, do you see in the financial sector, if any? Thank you for your time and expertise. Okay, Carrie, this is good because I'm obviously in the financial services sector, and I can tell you your intuition of is emotional intelligence an important thing? It's like the most important thing. Every single one of my advisors in my firm, one of the things we look for is emotional intelligence. So I think it's a huge market. I think you should be going after it aggressively, just based on what I know of my industry. Now, I did take some time to look at your website. I think what you might want to do are a couple things. Number one, I would probably have like a separate page that says what you do is just for financial services. I think having that kind of customization is pretty important, because if I look at your site, it looks like you handle lots of different people. And me as a financial professional, I'd be really impressed, because I've never seen this before. If you were to say, hey, we do this just for people in your field, I don't think there's any market for that out there that I've seen. Now, in terms of marketing it, and I like your thoughts, because marketing, it's all about marketing, is I think a lot of the publications or the rags that are in our industry, like there's Financial Advisor magazine, CityWire is a new one. I'll put some of these in your question section here. I'll give you a list of them. I may have a couple connections there, like the CityWire one. I may be able to introduce you to some people there. These are the type of publications that people in my industry read. So I think that's a good place to look to advertise. I mean, if you get published like with an article, I don't know if you have a PR firm. I have one out of New York that's pretty good that might be able to help you, because they're well connected in the financial services space. But I think anything that has to do with the kind of publications we read. The other thing are conferences. A lot of financial advisors go to conferences. I try to go to at least one every year. If you could get some sort of speaking gig there, or set up, some sort of stand there where all the vendors are, I think, that would be a great place for you to go. So I think anything that's magazine related to the financial services industry, and any sort of conference that you can get into. I mean, speaking would be the creme de la creme, but I think there's a huge need for it. I think advisors are very cognizant that it's a big need. And I think if you could position yourself as someone that's your niche, and again, maybe even putting up a page that just speaks to that, just a landing page specifically that talks about how you help financial advisors, I think that would be huge. You probably have some more questions about that. I'll put those links in the bottom here, and I'm sure there's some connections I can get you as well, or make some introductions for you there. So I'll put my email in there as well, so you can hit me up. But I think that could be a huge opportunity for you. I'm actually pretty excited for you, because I know it's a need in this industry. Okay, next question is coming in from, I have a lot of questions on here. Okay, Edward Morgan. Edward writes in, hi Ryan, thanks again for your time. You're welcome, Edward. My pension plan is currently 50% in a balanced fund and 50% in a growth fund. I have 28 years left until my pension matures. With this time frame, would you recommend that I put 100% of my contributions into the growth fund option, or at least a higher percentage than 50%? I used to contribute more towards the growth fund until one year, 2009, I think, when the markets, right after the market took a big hit, when 80% of what I put in there disappeared. So that freaked me out and made me more conservative with my risk. Yes, I think a lot of us can relate to that. Edward, back in 2008, we had a huge decline in the market, and there was a lot of panic, and a lot of people sold out of their 401ks or went to cash, and they never really got back in fully again. A couple of things here. I have to speak a little bit more generically. Well, first off, you have 28 years, so more aggressive probably makes sense. But these options here seem very limited to me. I would never want to put everything into the quote-unquote growth option. And the reason being is when you put together a portfolio, or you're putting together money that you're saving, and this is probably good advice for everybody, you want to do what you've probably heard before. It's called diversification. And most of us are probably like, I don't know what that means. I hear that all the time. Well, let me just break it down for you in a really simple way. It's just having your money spread out in different investments that may work at different times. Or it's like if you had a farm, you wouldn't plant just one crop. You'd plant lots of different crops so that you could always, have something to harvest. Same thing with your portfolio. You don't want all your eggs in one basket. And just putting into the growth option, I suspect, is probably going to just concentrate it in one area of the market. So when the market goes down like it did in 2008, you're going to set yourself up for the same type of massive decline in your portfolio. So a couple questions I would have for you. Number one, are there other options that you can put your money into? If that pension plan is still active, I would find out if there's other options. You have them, I could walk you through them. If there's a bigger menu than what you posted here on this actual Facebook posting, I see you put like 4 options here. Secondly, do you have another plan that's active and this plan isn't active? If you're self-employed, sometimes you can set up a plan for yourself, and then you can roll the money tax-free out of that plan, and you can put it into a different account where you can give yourself access to a lot more options. Because just looking at this limited menu, it's going to be very hard for you to diversify your money properly. And I think you should be more aggressive because you're younger, but I think you want to do that with some diversification in mind. And this doesn't quite look like it's able to do that for you. Okay, so again, I'll put my email in there under your question. And then if you want to see if you have other options that you can go into or a better diversified portfolio, or again, if you're self-employed and there's other things you can do plan-wise, but everybody should be thinking about that. Any of you are saving for retirement, putting money away, you want to think about the diversification of that money. And I will tell you, just in my experience, we probably have, close to 50 proposals we do a month. I probably have seen every investment strategy under the sun. And the one thing most of you are probably guilty of are, number one, you're probably sitting with too much cash. A lot of us after 2008, we had that big hit in the market and we got very gun shy about what we do with our money. But remember, sitting in cash, you're earning nothing. And number two, you're not diversifying your money properly. You probably have a lot of what we call overlap in your portfolio. And it's important to spread that overlap out, because again, if things go down, or the proverbial, things will stay there. If things go down, you're going to put yourself in a very, very risky position, and that's going to be hindsight. So you want to be proactive about your allocation, get rid of any overlap in your portfolio, diversify. Okay, I hope that was helpful. Let's keep moving here. The next question comes in from Kobe Lomax. Kobe writes in, as a startup, I'm curious to know what I should be doing with the revenue my company earns. I'm a college student, 20 years old, awesome, and I'm running my company, running my company has been the first time I've actually had a comma in my bank account. That's with an exclamation point. Awesome, man. That's 20 years old and building up some cash. Excellent. The issue before was that I ended up spending it on things like way too much raw materials, which led me to having my limited resources sitting on shelves until products were made and sold, or I'd buy fancy equipment when that money could have been spent somewhere else. So really curious to know where the dollars that come in should go. I watched this video that said 30% should go to a tax account, 30% to business expenses, and then the rest would go to investment, saving, etc. What would you recommend? Okay, first off, man, congratulations, 20 years old, you're an entrepreneur. I'm jealous. It took me another decade before I even started the entrepreneurial journey. So I love the fact that you're thinking about all these things, and it sounds like your business is profitable. I think rule of thumb number one is you just need to have a good understanding of what your expenses are. What's your set overhead going to look like moving forward? And I think you need to have some sort of cash reserve always. And for your business, it really just depends. I don't know how cyclical your cash flow is, but one rule of thumb you can have is maybe 6 months worth of expenses just set aside for anything can go wrong in your business. It's always good to have something there in case let's face it, things don't always go right when you're running a business, and we all have our stories we could talk about for hours, on that topic. The other thing I would think about is, and this is what I look at with my own firm, is how much money, after all my expenses are paid, we have the proverbial profit, right? Whatever's left over between whatever you sold, then you paid off all of your overhead, and then what's left is what maybe after you paid yourself even, right? Then on top of that would be profit. And what I struggle with my business, and what I think about all the time, is how much am I going to reinvest that back into the business, and how much am I going to take home just to take some risk off the table? There's a lot of risk with putting all your eggs in one basket. We just talked about diversification. And I think it's smart to get some money out of your business, diversified on the side, because there's just always the unknowable. So with that profit, I think you have to determine And this can be a little bit more of an art than science, and maybe you can work with the metrics a little bit. Like I know every year what we're going to spend on marketing. That's whatever I take my profits, we take a big chunk, and that becomes our marketing budget for the year. And then we put it right back into the business and use that as ways to grow, build out our channels, and build out how many people know about us so they come in and do business with us. So I think what you would do there is you decide on a number there, look at what your profits are and pick a percentage of those profits to start with and reinvest it, but you have to track it. Okay, and one thing we've gotten better at, which I can't say I was ever good at, was tracking how well our marketing is done in the past. I had a vague idea of how it did, but now we really look at, okay, I'm spending this amount of money. How much did we actually gain, or what was our return on investment on that? And if it's good, if it's like, okay, with the money I've spent on marketing and things, my return on investment is actually really, really solid, maybe you can up that marketing budget a little bit. Like for us, I'll give you an example. We do a lot of radio, and radio airtime is not cheap. So when I started, I went on a much smaller station, and I did it with a much smaller budget, and I realized after a while we were getting some traction with it. But if I spent, in this case, it was double, and I got on the best time slot, on the best day of the week for radio, which happens to be the weekend, and I looked at I just put on an Excel spreadsheet, and I looked at exponentially how many more leads and clients we could get from that. It made a lot of sense because I did that micro, or I did that smaller test first. So I think that's a good rule of thumb too, is whatever marketing initiatives or whatever return on investment you're looking to get, what kind of investments you're going to look for a return, maybe dip your toe in the water and do it on a smaller scale first, and then you can leverage it up later. So I went a little bit of a tangent there, but I think that's the key there is like, okay, what are your profits? Take a percentage of those profits for reinvestment purposes, but don't go crazy. Try it on a smaller scale, and if it works, you can start to leverage that up, and then you can take even more of those profits. But always, have your cash reserve, and I think if you're getting to a point where not everything has to be reinvested back in the business, then you want to start looking at maybe a retirement account for yourself, somewhere you can put money away where there's tax advantages. So I hope that's helpful. I know that was a lot, but again, I do think that you do want to reinvest. You just have to be careful on how you do it. All right, next question comes in from Jason Antonino. Jason, I think you've actually put some questions in before. Hi, Ryan. I'm currently contributing 5% of my gross salary, approximately $55K, towards my 401k plan, and my employer matches half that amount, so a grand total of 7.5% a year, which works out to $4,000 per year. My 401k balance is $55,000, give or take. I'm 45 years old, so my retirement age is 15 to 20 years away. My question is, would it be a good idea to suspend my contributions for a while and put those funds towards my business, or would a business line of credit make more sense for a startup biz? I'm considering these as last resort options. Thanks. Okay, so a couple of things. First off, I would never not contribute to your 401k up to the match, because whatever you put in, they're matching. That's free money, right? I don't know anywhere in the world I'm getting free money anywhere else, but that match is essentially free money, because all you have to do is put X amount into your 401k and you get the full match from your company. There's no way I would stop that. That to me is a no-brainer. You should do that. And I also think that, look, we all believe in our businesses. We all are really putting a lot of our sweat, a lot of our equity is tied up in our business. It's just so smart to take some money and just put it aside for retirement or financial independence that's not contingent on your business. Because let's just say, God forbid, something with your business doesn't work out and you put all your eggs in one basket, you're going to be in a really, really desperate situation. Whereas if you continually put money away somewhere else for your nest egg, and all of a sudden something doesn't go right in your business, but hey, I've got this big 401k over here I've been putting money into every year, it's a nice safety net to have, and it diversifies yourself from your business. I think if any theme you want to talk about today, it's thinking about diversifying or managing your risk. So I think first and foremost, definitely keep doing it. Now, the other question you asked here was, do I take a business line of credit out? And I would say potentially, because if you look at interest rates right now, we're at historical lows. I don't think interest rates have been this low since the 1960s. You look at mortgage rates right now, you look at business loan rates, it might be a really good time to borrow money from a bank just because the rates right now are so attractive. And if you can lock in for 5 years or 10 years, you could get a really favorable rate to do that. Now, if you still need other monies, in a lot of cases, and I don't know what your company's rules are, but most companies have a 401k plan that actually has a loan provision, okay, where you could actually borrow from your 401k if you needed to, and then you would pay back that loan over time, and you're just paying it back to yourself with interest. So, if there is a last resort, or there's not really favorable rates to borrow from your local bank, then you could take a loan from your 401k, which can be a very good option. And on top of that, you could even continue to save into your 401k, which I'm advocating is huge, and you should definitely do it. So bottom line is, yes, absolutely contribute to the 401k, never give up the match. That's huge. And then I would look at the interest rate that you could get on some of these lines of credit. But in addition to that, you could also look potentially to take a loan against your 401k and pay the interest and pay the principal back to yourself right back into that nest egg. Okay, so hopefully that's helpful. Again, hit me up offline if you have any more questions about that, but that's actually a really good question. And I imagine a lot of you are in the same boat there. Okay, we will keep moving here. Last question of the day comes in from Robin Turpin, who's written in before. Robin, good to hear from you. Hi, Ryan. Thank you for mentoring us about financial planning. My pleasure. I really enjoy doing it. My question today is, how much money does a person need to have before they even think about hiring a financial planner? Thank you. Great question. Okay, so I have a couple thoughts on this. First off, I don't think it hurts. I don't care if you have $5,000 or $100,000 to sit down with somebody, even just an initial plan, because you can have some of these advisors that for a fee, you could sit down, they can give you an initial plan. So if you're just getting started, I think that's not a bad way to go. At least sit down with somebody at least once, and you can pay them for their time, because there's a lot of things that you want to get locked down even when you start saving, and you want to build the right framework that you can build your plan from. So you don't want to wing it in the beginning and then try to correct it later, which most of us do. So if you could sit down with somebody just, I don't know, one time and just get the ball rolling, and that could be everything from, okay, let's run some projections on when I can actually retire or when I'm going to be at that financial independence. I want to know what that date is. Maybe it's 60, maybe it's 65. And then once you know that number, you can start looking at, okay, how much do I need to live on? These are really important things that you need to know. And you got to know exactly what you're living on now, and then what that's going to look like in retirement in today's dollars. And then you can reverse engineer that. Then you can go back and be like, okay, this is what I need to save every year, or this is what I want to aspire to save every year. And once you know that number, the next layer to this is, okay, where's the best place to save my money? We just talked about the 401k. 401k can be a huge tax advantage for you. You being a business owner, a lot of times there's other tax advantages that regular people don't have. There's other creative ways that you can put money away. I have a famous saying, money saved in taxes is just as green as any money you can make invested. You want to look for every tax opportunity you have to exploit to your benefit, and there's a lot out there with how you can save your money. So instead of just putting it into a savings account, there's a lot of ways where you set it up right now that can pay huge dividends to you down the line by just being smart about taxes and save you a lot of money in the long term. So I think when you get into a more long-term relationship with a financial advisor, when you're getting around $100,000, I'm going to throw a number out, and you're saving aggressively every year, or even if you have $50,000, but you're really starting to save your money, then I would say you probably want to have a full-time financial advisor that's looking over your stuff periodically, every year sitting down with you, retweaking your goals, looking at different things you can be optimizing. Because as you're creating your wealth, especially if you're really saving aggressively, if your business is doing well, that's when you really want to fine-tune things and how you're doing things. It's not just about being invested in the market, but it's just like we talked about before. It's like being properly diversified. It's managing the risk. Once you start to build that nest egg, you don't want to screw it up. And then it's all about those little tweaks. Like, what am I doing in terms of taxes right now? And estate planning, just the holistic stuff too. Like, do I need a will now? If I have a will, how should that be structured? So, essentially you want to get to that level, but I say about 50 to 100,000 and you're starting to save more aggressively, you should really start thinking about a full-time advisor. I hope that's helpful. And I believe, let me just go through, We could be at the end of our questions. We move and groove. It's already 25 minutes. That went really fast. I think that's pretty much everything we have. Yes, I think we're good. Okay, I think we hit all the questions today. Well, first off, thank you again, as always. I really enjoy doing these. I will put a lot of my answers right in the bottom of the invitation, wherever that was on the calendar, for every question that came in. Anything I promised, I said I'd follow up with you on, and then I'll do one of these again another 30 days. So anything you have related to wealth management, again, growing your business, I'm happy to answer them. It's a lot of fun to do this for you, and hope everyone's enjoying the rest of the year. 2 months left to go. You know, stay on your goals, stay focused, and I like the fact that everybody's thinking about their wealth and getting financial independent. It's what it's all about. So get the game plan together, and we'll do it again soon. Thank you very much.